Why do businesses record income or expenses they haven't even paid yet? If you watched the previous lesson, you already know the answer. Adjusting entries help make sure revenues and expenses are recorded in the correct accounting period, even if no money has been received or paid yet. Now, we're taking the next step. Instead of asking why adjusting entries are needed, today's question is, what kinds of adjusting entries are there? The good news is that almost every adjusting entry you'll encounter falls into just 4 main types. In today's video, I'll give you a simple overview of each one so you can recognize them. Then, in the next 4 videos, we'll dive into each type individually with journal entries and step-by-step examples. So let's begin by looking at what all 4 types have in common. This slide is gonna be the foundation for today's lesson. Take a look at the 2 columns. On the left, we have situations where the activity happens first. An activity would include things like delivering goods to a customer, providing a service, or using an expense such as electricity or rent. But the cash is received or paid later. On the right, we have situations where cash comes first. This means that the business either receives money from a customer or pays money to someone first. And the activity happens later. So every adjusting entry is really about timing. It's simply asking, did the activity happen first or did the cash happen first? As we go through the 4 types, keep coming back to this question because it will help you identify each one much more easily. Let's start with the first type, where the activity happens before the cash. Accrued revenue. Notice the order on the slide. First, the work is completed, such as delivering goods or providing services. Then, the payment comes later. In this example, Alex Consulting completes a project today, but the client will pay next week. So the business has already earned the revenue even though no money has been received yet. For now, just focus on the pattern. Work first, money later. We'll cover the accounting entry in the next video. Now let's look at the opposite of this idea, but for expenses. Accrued expense. First, the expense happens. Then, the payment comes later. In this example, Alex Consulting uses electricity during the month, but the bill is paid next month. Even though payment hasn't been made yet, the expense belongs to this month because the electricity has already been used. So the pattern is expense first, payment later. Now, let's try to switch direction, where money comes before anything else. Prepaid expense. As you noticed, the order changed. Here, money is paid first, then the benefit is received later. Let's look at the example. Alex Consulting pays for 1 year of insurance today. Although the cash is paid up front, the insurance provides benefits over the next 12 months. This means the expense isn't recognized all at once. Instead, it's recognized month by month as the insurance coverage is used. So the key idea is, money first, benefit later. Now let's look at the final type. Unearned revenue. Here, money comes first as well. Then, the service is provided later. Let's say Alex Consulting receives payment before the consulting work is done. Even though the cash has already been received, the revenue isn't recognized yet because the service hasn't been provided. The revenue will only be recognized once Alex Consulting completes the consulting work. So the pattern is money first, service later. Now, let's bring everything together. These are the 4 main types of adjusting entries. 2 of them happen when activity comes first, while the other 2 happen when money comes first. Instead of memorizing definitions, focus on the timing pattern. If you understand timing, you can identify all 4 types. We can also group these 4 types into 2 categories: accruals and deferrals. Accruals happen when the activity comes first and cash comes later. And deferrals happen when cash comes first and the activity comes later. These 4 types cover most of the adjusting entries you'll see at this level. But there are other few adjusting entries that don't follow this timing pattern. We'll look at those in a later video. Now, it's your turn. Look at each situation and decide which type it belongs to. Don't think about the counting rules yet. Just focus on timing. Did the work happen first, or did the money come first? Paying rent in advance. This is a prepaid expense because cash is paid first, but the benefit, using the office space, happens over time. Rendered service today, but paid next week. This is accrued revenue because the work is already done, but the cash hasn't come in yet. Customer pays before services are delivered. It's unearned revenue. Cash is received first, but delivery happens later. That creates an obligation for the business to deliver in the future. Uses electricity, but pays next month. The expense has already happened, but the cash payment comes later. That makes it an accrued expense, because the expense is incurred before payment. Today, we covered the 4 main types of adjusting entries. So remember, everything comes down to timing. Either the work happens first, or the money comes first. This was just the overview. In the next videos, we'll go step by step through each type with examples and journal entries.